Let's talk about gold, the shiny metal that's obsessed humanity for millennia. From pharaohs to modern investors, gold has always symbolized wealth and stability. Its magic, scarcity and durability. You can't just make more gold, and it never rusts or decays. That's why in times of crisis, people trust gold over paper money. Gold is a global language, accepted everywhere, valued by all. It's not just another commodity, it's a financial icon with a legacy stretching back to civilization's dawn. But even the most reliable safe haven faces challenges when central banks, like the Federal Reserve, start tinkering with interest rates. As we dive into gold's modern story, remember, it's more than bling, it's the world's original security blanket. But what happens when the rules of money change? For most of human history, money was something you could touch. Often it was shiny, heavy, and made of gold. Gold's allure wasn't just about beauty, it was about trust and value. The ancient Lydians, in what is now Turkey, minted the world's first gold coins over 2,500 years ago. This innovation made trade easier, unified markets, and helped economies grow stronger and more complex. Over centuries, gold became the ultimate measure of wealth and power. Eventually, nations adopted the gold standard. Currencies, backed by actual gold reserves, linking paper money to real physical treasure. This system kept governments in check, preventing them from printing endless money. It enforced financial discipline and brought a sense of stability to economies around the world. But the gold standard had its flaws. Economic growth was limited by the amount of gold available. During crises, countries couldn't print more money to recover, leading to painful recessions and panics. The gold standard cracked under the immense pressure of world wars and the Great Depression. People lined up at banks, economies faltered, and trust in gold-backed money began to erode. Nations abandoned the gold standard for more flexibility, allowing them to respond to crises. By the mid-20th century, gold's reign as the king of money was coming to an end. The world was on the brink of a dramatic transformation in the global financial system, setting the stage for new forms of money and economic power. Gold's role in the world economy was about to change forever, as it was locked away and replaced by new ideas. What came next would redefine the very meaning of money, opening the door to a new era of finance and possibility. August 15, 1971, President Nixon ends the dollar's link to gold, launching the era of fiat money. Now currencies were backed only by government promises, not precious metal. Central banks could print money freely, fueling both economic rescue and inflation risk. Gold. Once the system's anchor became a free-floating asset, its price set by the market. Investors flocked to gold, fearing governments would print too much money and devalue currencies. The 1970s saw economic turmoil and soaring prices. Gold's moment to shine as the ultimate anti-inflation asset. Gold's job changed, from monetary backbone to crisis hedge. It was no longer a government tool, but a private lifeboat in financial storms. The gold standard was dead, but gold's story was far from over. Now, it thrived on uncertainty. After gold's wild 1970s rally, the 1980s brought a crash, thanks to Fed Chair Paul Volcker. Volcker's weapon against inflation, sky-high interest rates peaking at 20%. Suddenly, government bonds offered huge risk-free returns, making gold's lack of yield a big drawback. Investors dumped gold, chasing better returns elsewhere. Gold's price collapsed and stayed low for decades, sidelined by stable economies and attractive bonds. The lesson: when the Fed offers stability and high rates, gold loses its shine. Gold's value now depended on central bank decisions, not just crisis. The metal's fate was tied to a handful of policymakers in Washington. In the 2000s, gold made a comeback. The dot-com bust, 9/11 and rising uncertainty revived gold's safe haven appeal. The Fed slashed interest rates, making gold attractive again as opportunity costs vanished. Then came the 2008 financial crisis. Panic sent gold soaring as trust in banks and paper money evaporated. Central banks printed trillions, fueling fears of inflation and currency debasement. Gold hit record highs, proving its worth as a crisis hedge. Low rates and money printing made gold the star asset of the era. Gold wasn't just back, it was essential, but the dance with the Fed was far from over. The COVID-19 pandemic was gold's ultimate test. As the world shut down and uncertainty gripped global markets, investors rushed to safe havens, and gold's reputation as a store of value was put under the spotlight like never before. The Fed slashed rates to zero and printed trillions, flooding the economy with liquidity and sending gold to new highs above $2,000 an ounce. Investors saw gold as a hedge against the risk of runaway inflation and currency debasement. But by 2026, the script flipped. Faced with surging inflation, the Fed hiked rates to levels not seen in decades, determined to rein in rising prices and restore stability. Historically, high rates crush gold, yet gold stayed strong, defying expectations and holding its ground even as borrowing costs soared. Investors bet the Fed will soon cut rates, keeping gold's price elevated. Many believe that economic headwinds will eventually force the central bank to pivot, fueling further gains for gold. But if the Fed holds rates high for longer, the opportunity cost of owning gold rises, making it less attractive compared to interest-bearing assets like bonds or savings accounts. The market is in a tense standoff. Gold's high price depends on future rate cuts, and every Fed meeting is watched with bated breath by gold investors worldwide. If those cuts don't come, gold could face a sharp correction, with prices tumbling as investors seek better returns elsewhere. The longer the Fed stays hawkish, the greater the risk for gold. Each month of high rates adds pressure, testing gold's resilience. Gold's fate now hangs on central bank policy, not just crisis. The metal's future will be shaped by decisions made in boardrooms, not just by global turmoil. The old rules are being tested, and the relationship between gold and interest rates is more complex than ever. Will gold finally break or break out? The answer may redefine how we see gold in a new era of monetary policy. Why hasn't gold collapsed under high rates? Because 2026 isn't 1980. The world has changed, and so have the forces shaping gold's price. Today, gold isn't just reacting to interest rates, it's responding to a complex web of global events and financial strategies. Geopolitical risks are soaring. Conflicts and global tensions keep gold in demand as a chaos hedge. Every new headline, from wars to political instability, reminds investors why gold is seen as a safe haven when uncertainty strikes. Central banks, especially in China, Russia, and India, are buying gold at record levels to reduce reliance on the US dollar. This isn't just about reserves, it's a strategic move to gain more financial independence and stability in a shifting world order. This steady strategic demand props up gold's price, regardless of Fed policy. Even as rates rise, the sheer volume of central bank buying creates a powerful floor under gold, making it harder for prices to collapse. Persistent inflation fears also drive investors to gold as insurance against future money printing. With memories of recent inflation spikes still fresh, many see gold as a shield against currency devaluation and economic shocks. Gold is caught in a tug of war. High rates pull it down, but global fear and central bank buying hold it up. The market is constantly balancing these opposing forces, creating volatility and uncertainty about gold's next move. For the first time, gold's future depends less on crisis and more on the Fed's next move. The central bank's decisions now have an outsized influence on where gold goes from here. If the Fed cuts rates, gold could soar. If not, it may finally fall. Investors are watching every signal, every word, waiting to see which way the scales will tip. Gold's ancient role as a store of value faces its toughest modern test. For thousands of years, gold has weathered every storm, but today's financial landscape is more unpredictable than ever. The showdown between gold and the world's most powerful central bank is just beginning. The outcome could redefine what it means to be a safe haven in the